Joining me now is Potomac Wealth Advisors President Mark Avallone. Mark, we should, I guess, look for some kind of a dip, but are they buyable, and should you look at certain types of sectors over others?
Well, the market's, we're still in a bull market. So when we talk about volatility, we're really talking about an end to the consecutive days, up days. We're looking at froth in these SPAC stocks. We're looking at oil on rising with other commodities, and even high yield bonds now are dipping. The yields are dipping into investment grade bond territory. When you look at all that, clearly investors are optimistic, and optimism sometimes has to be tempered. And when it does, it weeds out some players that aren't committed. It weeds out investors that are in for quick trading gains and creates a foundation for a next leg up higher. And we think that next leg up higher continues 2021 with a relentless Fed, with vaccines, with congressional money, prudent or otherwise, coming out into the market. I think that creates a good year, good opportunity for investors, any pullback we get.
It's the billion-dollar question, and I know that you're not a fortune teller, Mark, but you are an investor. How deep of a pullback can we expect? Is it a 5 to 10% type thing? Is it even broader than that? I'm not sure many people are foreseeing a 50% pullback, but some people are. So what exactly is your base case for the type of pullback that we would see?
It's not the crash style event, and that has been the problem. We have a lot of investors with cash on the sidelines, and they ask us that question almost every day. Look, the reality is as soon as we get a 2, 3, or 4% decline, money rushes back in. When you have $5 trillion of cash by some accounts on the sidelines, and a lot of people waiting for this, they keep moving stocks up higher. This is an unloved bull market. This cash on the sidelines is a bullish indicator. Negative pessimism is a bullish indicator. So it's really difficult. And I think a mid-single digit correction is something that these investors will eat up and get right back into. I don't think we're looking at a big correction here because the underpinnings and the liquidity from the Fed are too strong. But I think any opportunity, investors are jumping on it. And that's what's keeping people on the sidelines.
What exactly are people buying? What are your clients asking you about with regard to where the opportunities are right now?
Well, I think people are segmenting some of their investments. There's too much glory out there to not be in these unproven companies and new tech names. And a lot of people are gaining a risk appetite to be in the technologies of tomorrow. But there are sound fundamental sectors that are working. We think financials are going to have a great year. I saw your chart earlier on 2 years and 10-year treasuries. When you start getting a widening in the yield gap and you get an upward sloping yield curve, those are really good for banks. And we also think banks are going to head through a mergers and acquisition wave this year. We saw the start of it with SunTrust earlier in the year becoming Truist now. And we think that banks need to gain scale. They need to compete. They need to pay for technology. They need to fight off these online deposit wars, which are raising their cost of funds. The best way for them to do that is to merge and join forces. That's going to raise valuations in the banking sector at a time when interest rates are going up. We think that financials are going to lead a continuation into this value trade that we've seen earlier this year and late last year.
We've just got about a half a minute left here. What do you think are the biggest risks right now to the market overall?
Biggest risk is a change in interest rates, either market-driven driving yields up or the Fed changing tone. Unlikely the Fed changes tone because half of their mandate is full employment, and we're far from full employment. But we think the market, the movement up in rates could eventually make some bond yields attractive and could take some luster off of those tech stocks, which tend to flourish during low rate environments.
All right. Great thoughts for sure. Mark Avallone of Potomac Wealth, thank you very much for joining us. We appreciate it, sir.